Hello, fellow business owners. Welcome to today's edition of R.BizThoughts. I'm Deb Sands with Priority Leasing in Calgary, and my co-host is Paul Moffat with iPrimeline in Langley, BC. Today, Paul's going to take us on a journey of learning about and understanding the numbers in our businesses. Sometimes when we're making a lot of sales, we assume we're also making a lot of money. And as Paul will point out, that's not always the case. Just to recap our business models, Paul sells a product, which is telephone systems, telephone lines, telephone software. And at Priority Leasing, we sell a service, which is equipment financing. We are paid by commission, and Paul's company is paid totally differently. So we're going to look at the differences and the commonalities in the two, and then Paul will show us where we may be losing more than we're making. So without further ado, I will invite to the table my co-host, Paul Moffat, and we'll get started. We'll be right back.
I thought I'd do a presentation this week, and I actually put together a PowerPoint presentation because it's just a lot easier to explain numbers doing it over a PowerPoint. So I'm going to put on a presentation if that's okay with you.
That sounds wonderful. Okay, I'm in.
So I'm just going to start.
Get the popcorn.
So I actually have put together a little graphic presentation.
Look at you. That's awesome.
So what I wanted to talk today about was probably one of the biggest lessons I ever got on how to run a business, because for years I was told by business gurus and trainers, you just have to get your sales up. Mm-hmm. And so we focused for the longest time just trying to get our sales up. And then I learned you got to make money while making sales. I know that sounds simple, but a lot of people really do not understand their numbers. So this is about why it's so important to know your numbers and if you're being profitable or not.
Makes sense.
So this is from a book, which I totally agree with the concept. It's a Simple Numbers, Straight Talk, Big Profits by Greg Crabtree.
Okay.
And what he said is that 10% is the new break even. If you're not making 10% profitability, you're not making it. If you're making 5% or less in pre-tax profit, it means your business is on life support. Anything goes wrong, any extraordinary expense, any hit from any direction can take you down.
You mean like a pandemic?
Like a pandemic. Well, that could be a whole talk into itself. But if a pandemic hits and you're redlining in your business, you won't make it out the other side.
Absolutely. So let's not go there. Let's just talk about normal daily businesses and what happens when you. Yes, exactly. When you're close to the line.
So 10% of pre-tax profits means you have a good business.
Okay.
It allows you to make a rate of return on your investment. So I consider you have to build in your salary within the expenses of your business, and the profitability is after an owner takes a reasonable salary for what they do.
Okay, just so I understand, the profit is after the owner takes a salary.
Yes.
This 10% you're talking about. Okay.
Yes, you're making 10% after taking a salary as an owner.
Okay.
And 15%, as he said, profit means you have a great business. Very few businesses hit 15%, but that should be where you're planning, is to be at least 15% in order to have a great business.
Right. Makes sense.
So the example I use here is, if you did $1 million years of sales or $1 million a year in sales at different profit levels, if you're making 3% profit to the bottom line after $1 million in sales, you're basically getting minimum wage.
You as the owner.
You as the owner. If you made $30,000, that's basically $15 an hour now for an employee. So that's not a very successful business, really.
No, and as business owners, we want to make more than minimum wage.
Yes.
Okay.
And the other point I'd like to make here is if you triple sales, at $1 million, you go to $3 million, you'd make $90,000. And that's with triple the overhead, triple the effort, and triple the risk.
Okay.
So it's too razor thin to be comfortable.
So even at $3 million in sales and $90,000 profit, you're still making minimum wage.
Well, you're still making $90,000, but the point I wanted to get to was that if you make 10% profitability in $1 million, you would make more money than if you tripled sales at 3%.
Oh, okay. I see. I see what you mean.
So at 10%, at least you're making 100,000 in profit, and this should be the minimum considering the risks you've taken, the extra hours you've worked to build the business.
Exactly. Okay.
And then 15% would be $150,000 in profit, and this is really where you should be shooting for. Now you've got a successful business.
Okay.
And the concepts are same no matter what the top line number is. It's the profitability that is the most important thing to work towards.
And that's after all of your expenses are paid. You've been paid 15% is the profit number you're aiming at.
Yes. So it's pre-tax profits. It's before what you've paid the government.
Okay.
But after all other expenses.
Okay. Got it.
So in the business world, we talk about EBITDA a lot. It really isn't that applicable for smaller businesses. You should take into account your interest expense and amortizations and things and depreciation into account when determining your pre-tax profit. So it's a little bit of EBITDA is an accounting function. Can
you tell us what it means? EBITDA?
Earnings before interest, taxes, appreciation and depreciation. So
okay, got it.
Amortization and depreciation. Sorry, but so it's an accounting function of adjustments before you pay tax.
Okay,
to the government. So what I've done here is, say your average size sale is $10,000, and you've marked up your product 2 times, a 50% margin. These are how it can end up looking by the time you've gone through all the expenses. So in our world, we bought equipment. So we did a 50% markup, or sorry, a 2.0 markup on the equipment. This isn't our actual numbers. I'm using this as an example.
Sure.
But there's installations that are required. There's extra expenses. So even at a 50% margin, your cost of goods sold at best is going to be $6,000 out of that $10,000.
Okay.
So you subtract the cost of equipment, the labor, what it took to get something installed, and what you have left over is the gross profit.
Okay.
So this is where, as a service company, where you start. You'd bring in $4,000 worth of revenue.
Okay.
But in our world, we had a sales expense. We had to pay the salespeople.
As did we.
And we had to pay a sales manager.
Okay.
So, and even as a business owner, you should be paid as a sales manager if you don't have a sales manager. It ran around 16% of sales.
Okay.
This is what a lot of people don't take into account is overhead, or general and administrative expenses is what our accountants like to call it. And this is your rent. This is insurance. It's the payroll taxes. It's the office supplies you buy. It's the phone systems you have to pay for, everything that goes into running your business. And typically it's a fixed cost, and 20% of sales is a very generous number. It's usually a lot worse than this.
Okay.
But I use 20% just to make a point here.
Okay. Fair enough.
So when you subtract out sales expense and overhead expense, that $10,000 sale, you ended up making $400 in profit.
That is heartbreaking. Just heartbreaking.
It gets worse.
Okay. I'm buckled in. Lay it on me, soldier.
What happens if you give a 5% discount because you want the deal?
Guilty. Guilty as charged. Okay.
So what I'm showing here is the sale went from $10,000 down to $9,500.
Okay.
But your cost of goods sold stay the same. You still takes the same amount of time to install something or to do all the work to get whatever you sold to somebody in and working. So the gross profit now has gone down by $500. So you have $3,500 to pay all the other expenses. Sales expense came down a bit because the salesperson lost some commission, but probably not by this amount. It's probably is going to be a higher number, but good enough. Let's say they're on straight commission.
Okay. So
$1,520 would go to sales expense. Your overhead expense, by and large, is fixed. Your rent doesn't change no matter what your sale price is. Your office supplies, your
phone, the
all
internet,
that sort of stuff does not change in price.
Exactly.
So in this case, from a 5% discount, you went from 4% profitability down to minus 0.2% profitability, and you lost money on the sale.
That is just heartbreaking. Just by a 5% discount.
Yes. So,
oh my.
And people, I can't tell you often I've seen people give 10% discounts without even batting an eye.
Probably because the sale is more important. for their emotional well-being than the actual profit at the end of the month, which is
Well,
just like putting your head in the sand.
well, when business is slow and you got to get things moving, you'll make some decisions. And
Yes,
sometimes, and I guess the point is also, you may take that loss at that time just to keep your people working.
that's true.
But
Yes.
you're making an informed decision. You say, I'm willing to take the 0.2% loss, but I want the work. You're making informed decisions, not like, oh, well, it's better than nothing. Might as well get $9,500,
Yeah, exactly.
which is often too casual how people think.
Yes, totally. And then they're in such shock at the end of the year when they haven't made any money.
Yes.
For sure.
And so in this example, something went wrong on the installation of the product.
Okay.
In our world, TELUS didn't show up that day. We had to pay 2 people's wages to sit there and do nothing. So
Oh, ouch.
that could easily hit $500 in additional costs. So if that happens, gross profit is down to $3,500. Salesperson doesn't get a cut in commission. It wasn't
No,
his fault.
wasn't his fault.
So full payout on the sales expense. Your overhead hasn't changed. In this case, you lose $100 on every sale
Okay.
in this scenario.
And I think a lot of small businesses have factors like you have TELUS and Shaw as the people putting the lines in before you can come in with the equipment. Other businesses too are going to have factors outside of their control that are going to cause them to stall, but the clock keeps on ticking as far as the expenses going up. It's just very difficult.
And quite frankly, in our world, we sold a fixed price for the product. So we can't go back to the customer and say, you know what, TELUS screwed up. Can you give us an extra $1,000 today? Thank you.
Not a chance.
Not a chance. They're not going to
No.
give it to you.
Yeah, exactly.
So in this case, a year's gone by, you did $1 million in sales, but let's say you discounted half the time at 5%,
Okay.
half the time it didn't get installed as planned.
Okay.
So in this case, you'd have 975,000 sales. So you slipped a bit because of the discounting.
Mm-hmm.
Costs of goods sold went up a bit because of unforeseen circumstances.
Okay.
So in this case, we'd have a gross profit of $350,000 for the year on that $975,000 in sales.
After all the expenses.
And then we go into the expenses. So that's where your revenue would come in, would be the $350,000.
Okay.
You still got to pay your salespeople. They want
Yes.
their earnings.
Absolutely.
The sales manager wants their pay.
Yes.
Um,
The overhead.
Overhead is still going to be fixed at $200,000 for the year.
Mm-hmm.
Now, this is for making points. I mean, generally,
Yes.
there's a slight fluctuation, but it's very typically very fixed, the costs and overhead.
Absolutely. Yeah.
So that year, you lost $6,000.
Oh boy.
And that comes out of your pocket because no one else is going to come up with the money unless you can borrow from friends and family. But why would they give money to a losing business?
So, but Paul, if I understand correctly, you said at the beginning the owner is taking out a salary.
Yep.
So
Guess
the
what he's
owner's
giving back?
Oh, I guess so. Yes.
You have to go to the family and say, family, I need some of that money back.
Yeah.
And
exactly.
I'm being very real there.
Mm-hmm.
Where it's happened to me,
Yeah.
where I've had to go to my wife and say, we need to put money back in the business.
Yeah.
And that's a very hard talk.
Oh, I can imagine. And if you have children that want to take skiing lessons and go on school trips, yeah, that can be really hard.
Exactly.
So tell me something then, Paul. Where do people usually cut? Is it staff? Is it
That'll come up.
That's for another day?
Nope, that'll be discussed today. But one of the things is people now understaffed. They don't have enough people to support their business properly. So
Okay.
that'll be in my conclusion of some of the issues with this.
Okay.
So
I'll listen.
It's coming.
Okay.
So in this case, that year you lost $6,000. Now
Mm-hmm.
you go to your favorite business guru and he said, all you got to do is double your sales and everything will be solved. Well, guess what?
Okay.
If you double your sales, you have $12,000 in losses.
Oh, wow.
So even though your salary is the same, you're taking more out of your pocket to keep your business going.
Yeah.
Now look what happens if you triple the sales. You'd have 18,000 in losses. So the solution is not more sales in most cases. It's pricing things correctly so that you're making a profit.
Makes sense.
So if you lose money.
Oops, Paul.
What?
Loose money, as in.
Oh, sorry.
It's okay, Paul. We're all hanging on every word here. Let's keep going, and we'll worry about English later. So if you lose money, what happens?
Well, you're unable to pay your suppliers in time.
Okay.
You start getting to 45 days, 60 days. When you hit 60 days, often suppliers make you pay cash in advance, bill to buy product. So
Ouch.
it's showing you that you are running a poor business if you can't pay your suppliers on time.
Mm-hmm.
You're not able to support your clients properly because you will be understaffed.
Yeah.
And one of the first things people do is take on more workload themselves and let some of their staff go or somebody go just to try to break even. But now you're not able to support your services or products properly.
No, and as the business owner, you're suddenly working 18-hour days and your family doesn't see you anymore, and that's not good.
Yes, and you get so many people, I work 20 hours a day. Well, that's not sustainable.
No, and
It's
that's
not
not a life.
healthy. It's bad and all around.
Yeah.
You hurt your family by not being able to support them.
Mm-hmm.
It's tough to
Exactly.
say to family members, we can't do this month because we
Yeah.
didn't make any money in the business.
Yeah. Exactly.
And finally, you hurt yourself. It's hard on your pride and it's extremely stressful.
Yes. It is stressful. I've been there.
Well, I think we've all been there.
Yeah.
But what I really want to get across to people is they need to understand what their numbers are so that they can make decisions.
Mm-hmm.
And in many cases, it is to charge more for your products or services than you've been charging, just so you can stay in business and support your clients. You're not doing your clients any favor by giving discounts to them and then not being able to support them down the road.
That makes good sense. Absolutely.
And finally, the reason we go into our own businesses is I've been so often heard time freedom and money freedom. Do you ever feel like you have both?
No, not very often. Not in Alberta.
So if you hit at least 10% profitability, you can have a decent lifestyle. And that's what it's all about, is building a lifestyle for you and your family. So that's what I wanted to cover today.
Well, you did a very good job. Other than one small spelling error,
And
it
you
was
know what?
awesome.
No one would have noticed.
Yes, they would. Us English majors were all over it.
Oh, yeah? You just watch how I fix that before this comes out.
Okay, then.
I have tricks,
Okay. So that's all for today, then?
I would say that's all for today.
Okay. Well, thank you so much. You shared a lot of valuable information.
Hopefully you enjoyed it.
Okay. We'll talk again soon.